All right, we're live. We're live here at the Constructive House, and I'm sure everybody has gotten the title by now. How lenders approve mortgages, and it's based on your income, assets, credit, and property, and that's how you'll be able to get home approval or denial. Is going to be based on four key parts. Lenders look at your income, and most important, they're looking at your debt to income, and that's where your qualification around income is. I know I've dealt with a lot of mortgage applications, and some do feel that if you earn a certain amount of money, that should automatically just get you a house. And unfortunately, that's not the case. It is based on your debt to income ratios, which is your total monthly obligations. It's a monthly calculation they look at. But your total monthly obligations, that's including the proposed house payment, that'll be thrown in there as well as any other obligations or expenses you have on your credit report. That could be your credit cards, your auto loans, a furniture account, personal loans, home equity line of credit. There also may be some who use like any revolving debt that's reported or not reported, but that you're obligated to will be included. Any child support, alimony, those will also be included. So it is imperative that you inform your mortgage loan officer of any obligations you have that also are not on your credit report, but student loans as well, any fixed installment loans, revolving debt, and mortgage payments, any secured debt. Those are all included in your total obligations, or as I like to say, what's going out the door. What's going out the door, and your gross income, that's what you get before taxes and deduction. That's what's measured as far as your income. So it's debt to income ratio. So it's your total monthly obligations as it compares to your total income that's coming in. And in some cases, you can also use alimony and child support as income if that's going to continue for 3 or more years. Most banks are looking for a continuance of 3 years. Another source of income would be passive income, such as income that you may get from Social Security or disability, like VA disability. Also, income that you may get from annuities, stocks, bonds. That type of income can be utilized as well. Again, you do want to be able to show and tell that you have a 3 year continuance. And now that's my summary of the debt to income ratio. However, I did want to show and share with you all what Fannie Mae has as well. So, anytime you have any questions about guidelines and approval, first things first, keep in mind that mortgage lenders are looking at income, property, assets, and credit. That's how you complete a uniform residential loan application. It's going to be based on, of course, your contact information, but as far as approval, they're looking at your DTI, your LTV, your assets, as far as reserves, what you have as far as any ownership stake, and also your credit. And you need all four. So having phenomenal credit but risky DTI isn't going to help. Having phenomenal equity in the home, but your credit is poor, your DTI is very high, that won't help. So you want to make sure you have all pieces of the puzzle. And I did want to share with you as far as kicking things off with income, what debt to income is explained by Fannie Mae. I'll take a look at FHA as well because they do have different guidelines as it pertains to the debt to income ratio, what they allow. But Fannie Mae, and you can go on fanniemae.com as you see here. Fannie Mae says the DTI ratios consist of two components: total monthly obligations, which include the qualifying payment for the subject mortgage loan. So if you're doing a refinance, it's going to include whatever that new payment or proposed payment will be on the home, and other long term and significant short term monthly debts. It also is composed of total monthly income of all borrowers to the extent the income is used to qualify for the mortgage. So again, the two components: your total monthly obligations, which is debt, and your income. So you have a co-borrower, a co-signer, their income will be included as well. Any qualified income. Like I said, it can't be income you're getting paid under the table. So you may cut mow lawns or do hair on the side. That income can be used, but it must be reflecting on your tax returns. Since it's not traditional pay stub W 2 income, you'd have to file that income on your tax returns in order to use it, in order for it to be qualified income. So we do want to break that down. So if you are a self employed borrower and you're looking to find a home, because in my several years of experience in doing mortgage applications, one of the biggest challenges at times when it comes to DTI is my self employed borrowers. And a lot of times, and I get it, in order to pay less taxes, you'll show less income on your tax returns. The only thing about that is when you're paying less taxes and showing less income, the banks are only able to use the income reported on your tax returns. Typically, when you're filing your Schedule C, it's going to be line 31 that shows net income. That's the income that most banks are looking at, and mortgage companies. That's what they're looking at when they're reviewing your tax returns. So if you show a low amount of income so you can get a refund or so you can pay less taxes, that can come back and be a challenge when it comes to qualifying on the income side. Your debt to income ratios will reflect that income. So if you only report that you made $8,000 for the whole year, then that's the income that mortgage companies are going to have to use as it pertains to qualifying you on debt to income. Now, when that can be a challenge and will be a challenge if it's $8,000, let's face it, because that's the only amount of income they're able to use for you for that year. Now, most times it's going to be a 2 year look back on your tax returns and the average of those. But like I said, you want to look at Schedule C. Line 31 is typically where you're going to see that net income, and that's going to be that determining factor in most cases. Yeah, there are crafty ways where you can add back income based on mileage and things of that sort, but keep in mind, if you are reporting a low amount of income to pay less taxes or no taxes, that can be a challenge when it comes time to purchasing a home. So when you're going in to do your taxes, make sure you do keep your tax preparer or bookkeeper aware of that if you are looking to buy a home, because it can be a challenge at times. Or make sure that your co-signer, it does show the qualifying income so that you can buy the home. And that's what we're going to go over as it pertains to income, is what income, how you can be qualified or approved as it pertains to debt to income ratio. So for Fannie Mae, a solid debt to income ratio, well, for either guidelines, a solid one is going to be any DTI under 43 or 45%. You want to be as far under 43% as you can, meaning your gross monthly income is right here. You don't want any more than 43% of it going out the door to bills. Now, the bills that are not included are, your grocery, gas, car insurance, those types of bills, Netflix bills, those won't be included. It's just your obligations as far as credit cards, which is revolving debt. Any revolving debt that's reported on your credit report, any installment debt reported like student loans, mortgages, um, personal loans that you may take out, auto loans, those type of installment debts are included. All right. So make sure you're always brushing up on what's on your credit report, making sure the monthly payments are accurate. There's a lot of tools out now where you can stay on top of it. There's plenty of credit trackers, Credit Karma. Most banks have all these things where you can stay on top of how much is going out each month. And you can do a simple calculation. You're going to divide your debt and your income, and that'll determine that percentage. As a matter of fact, let me stop sharing this for a second just to pull up a quick calculation. Let me see if I can pull that up. So you can see it in real time and in real life, because sometimes saying it isn't always the best. Sometimes you want to see it, right? So let me see if I can share my calculator real quick. I should be able to. I'm not sure. Um, yeah. See if I can share that. All right. So let's say you make, well, let's say your total of your car, your auto loan, your student loans, your credit cards, all your monthly obligations, maybe you got a boat loan or what have you. Let's say that totals up to about 20, along with your house. Let's say that totals up to about 2,800. All right, that's your total debt. That's what's going out the door to credit obligations. All right. Now let's say you make $6,000 a month. You're gonna divide your debt to income. That's 6,000. All right. You're at 46%. You're at 46%. So you're above 43%. Now, keep in mind, if I was working with a loan applicant and they're at 46%, I would move forward with taking the application and working on approval, because there are a lot of guidelines. That's why it's four pieces: income, property, assets, and credit. If you have stronger credit, then we can get you pushed through on a 46%. If you got a lot of equity in the house, on the property side, we can push that through. As far as your assets, let's say you have 3 to 6 months worth of mortgage payments in the bank, which they call that reserves. All right. So say your mortgage payment is $2,000 a month. All right. You multiply that by six, that's $12,000. So you have 6 months of reserves in the bank. All right. Meaning if something happened, you'd be able to make your mortgage payment for at least 6 months minimum, because you have that in the bank. So things like that can make your profile stronger, as to where the debt to income being at 46, which is pretty borderline, may not be as much of a problem, because you have other strong compensating factors. All right. And FHA a lot of times will allow you to go up to 55%. However, you would be deemed a more riskier applicant. So you may not get the more favorable terms at times, as far as certain guidelines, but I've done applications at 55. I've even done 60%. Back in the HARP days, there was applicants that were over 100%. I mean, they were struggling, underwater, everything. But those loans were there to help those applicants. But we're looking for more. This is more of a foundation course for those first time home buyers, for those first time doing a refinance, those who are wanting to get more information, just general mortgage knowledge. This is to help and be a foundation course for you. But back to debt to income, let's say that the total obligations you're spending a month is $2,500, right? And you make 7,200 a month. All right, you're going to divide 2,500 by 7,200. All right, your debt to income is 34%. All right, so you're good in the income area there. Okay, now let's say you are a self-employed borrower and you reported your taxable income for the last 2 years was at, let's say, 32,000, and then the year before that it was 29,000. All right, we're going to add those together. Then we're going to divide them by 2. Again, remember, we're referencing line 31, your net income on your tax returns. All right, so your taxable income that will be used for qualifications will be 30,500. Now we're going to divide that by 12. All right, because there's 12 months in a year. Keep in mind, debt to income is based on your monthly gross monthly income, GMI, gross monthly income. All right, so the usable income will be $2,541 a month. All right, so keep in mind, your output needs to be less than half of what you're bringing in. So you're going to have to find a very lower housing payment, and you're going to need very little bills that are going out each month, or you're going to need to bring in a spouse or family member as a co-signer, a co-borrower for the loan, so you can add more income. Okay. Now, where this can be a benefit is if you're working a more traditional job and you also have a, as you would say, side hustle. Say you do hair on the weekends, you landscape, cut yards on the weekends. Maybe you get paid for being a pastor or speaking engagements. Um, it could be a host of things. Maybe you do taxes on the side. So that's where it can be an incentive. However, if you are a self-employed borrower, then you need to be aware of these things. Now, there are portfolio loans that come directly from the bank that aren't sponsored by Fannie Mae or FHA or USDA. The bank can directly give you those, and those are based on reserves. So you may show on paper you only are making this amount, but maybe your bank account, you have $80,000 in the bank or $90,000. Then a bank may actually do a different type of program, which we won't be getting into now because, again, this is a foundation course. But don't be discouraged if you're self employed and you're showing a lower amount, because there are alternatives if you do have reserves in the bank. Okay. But if you don't have those reserves in the bank and you are showing a low amount, then it can be a challenge to get approved, because it is your qualified income is what's going to be used. And if on paper you're saying you're only making $2,541 a month, and as we all know, if you're looking at houses now, a lot of your minimum mortgage payments are almost 3 grand monthly, 2,900, 3,200. I was helping a friend of mine not too long ago. His mortgage payment is going to be $4,200 for a 3-2 in Alabama. And I'm trying to remember what city it was in Alabama. It's over there where NASA's at. Anyone in Alabama reference that for me? But $4,200. So if he's showing this on his tax returns and he doesn't qualify debt to income wise, and it can be quite the challenge to get approved. But again, we go back, it's income, property, assets, and credit that's needed. Okay. So having an 800 credit score alone is not going to get you the keys to that house. You may have an 800 credit score, but if you make $2,000 a month and the mortgage payment is proposed at 3,000, you're going to be rejected for the loan. Like, we're going to be realistic. We're going to be realistic. Okay. That's one thing I don't want anyone to feel, is that you've been misled. So we're going to go over mortgage tips and some of the ways you can get around certain things, but there's certain stuff you can't get around. All right. I don't want it to be misunderstood there. So just to break it down once more, if your monthly obligations are $2,500, that's including student loan payments. That's including auto loans. If you have more than one, however many, that's including any other revolving debt. That could be your home equity line of credit, credit cards, Amex, American Express accounts, Diners Club, whichever you're using. Those are all factored in. Keep in mind, if you're paying alimony or child support, that also needs to be disclosed, because it may not be on your credit report. But once we're going into the loan application process, that will be pulled up. That will be pulled up and it will be included. So it's best to go ahead and unveil all of that up front so you can actually know where you stand while you're going through the application. But if all of those obligations a month, including your proposed house payment, whether that's a refinance payment or whether you're looking to buy a home and you're going over what that new house payment will be, that all needs to be included in those monthly obligations. And you're going to divide that by however much your gross monthly income is. So let's say you're making $6,000 a month. That's around a $60,000 a year income, which is pretty average for most Americans out here. All right. Now keep in mind, if a husband and wife both are making 60,000, that's 120,000 of qualified income you could be using. So keep that in mind. All right. Now that would bring your debt to income at 41.6 or 41.6%. All right. So it's not bad. It's not bad. You wouldn't be considered risky when you're getting your loan application submitted to Fannie Mae or Freddie Mac through the desktop underwriter. However, you are pretty borderline. So if things are close, and by close I mean, like, let's say you're looking to buy, you're competing for a home, you're bidding on a home, and let's say the other borrowers, potential buyers, are raising the price, then you can be a little restricted as far as how much more you can go up in price, because then you'll start being more risky on that debt to income ratio. Okay, so keep that in mind. The closer you are to 45%, the closer you are to being considered risky. Anything over 45%, even if it's FHA, is still viewed a little riskier on your income profile. It is. It just is. Can you get approved for those loans? Yes. And I'm sure there's some of you out here now saying, "Oh, I've done a loan at 50% debt to income." Yeah, you can do that. FHA will permit that for sure. They'll push that loan through. It can still get approved, especially if you have other strong compensating factors like a 680 credit score or higher. You're making a sizable down payment. You have 3 to 6 months reserves in the bank. Yeah, those things will get you approved. But keep in mind, we're right now we're focusing on income. Okay, on income, debt to income ratios, and anything over 45% would be considered riskier. All right, so keep that in mind. And let me stop sharing this real quick. So I hope that's making things easy as it pertains to debt to income qualifications. Like I said, I did want to go over. Let's see what FHA has to say about it. Let's take a look. Let's see what FHA has to say about it. Do I want to go on? Let's go here. Let's take a look here. All right. So the FHA debt to income ratio is a measure used by the Federal Housing Administration to determine if borrowers are financially qualified for an FHA loan. This ratio calculates the percentage of a borrower's monthly income that goes towards paying off debts, including housing expenses. If you've spoken with a lender, they may have talked to you about your debt to income ratio because it is the primary method of determining how much you qualify for. Again, the income portion of the application, the what lenders and banks are looking for is your DTI ratio. And this is something you can calculate at home. You could be at work. I mean, we'll go through Facebook, we'll go on Instagram, we'll go on YouTube. You can literally pull up your calculator, type in, I mean, you can pull up your phone, look at how much credit bills you have, pull out your calculator, put that total amount in there. Credit Karma breaks it down. A lot of them break it down how much your monthly bills are on your credit report. Put that in your calculator, divide it by your gross monthly income. You can pull up your paycheck as well to see that. You put it in there. That's your DTI. Boom. You know what it is. You can see that percentage. All right. The FHA guidelines allow for a DTI of 43%. However, much higher ratios of up to 56.9% are allowed with compensating factors. These FHA DTI limits are more flexible than conventional loans. So FHA is a lot more flexible when it comes to DTI than you're going to see on a conventional loan like a Fannie Mae or Freddie Mac loan. And again, I have another video out there about the difference between Fannie Mae, Freddie Mac, and a government loan like an FHA loan or VA loan. All right, Fannie Mae and Freddie Mac are government sponsored agencies. They're not the government, but they're government sponsored agencies that have set guidelines for banks to follow. That way, banks, all of their loans that they're sending out that are approved by the guidelines of Fannie Mae or Freddie Mac, the bank will then be able to have that loan bought off the secondary market, which allows them to lend more loans to borrowers, get more homeowners. That's the whole objective, is to get as many homeowners as possible. So if the loan is approved by Fannie Mae or Freddie Mac, the bank can then sell that loan in the secondary market and they'll be able to get more money to lend out to more homeowners. The same for government agency loans, the same concept, except the regulations are from the government. The Federal Housing Administration has their regulations, and the Veterans Administration has their regulations, and they're going through the same process. As long as the bank is following those guidelines, they'll buy those loans in the secondary market, and that's where the banks get more money to lend out. That's where it comes from. You don't have $500,000 in the bank. You go to get a loan for the 500,000. That loan is called a mortgage, and that's how you pay to buy the house. You make small payments, monthly payments, until you pay that loan off. That's how it works. In order for the banks to give you the money, they do need to have those mortgages qualified, clean, closable loans. They need to be qualified in order for them to be purchased on the secondary market. When they're purchased, then they can give out more money. So that way, when you don't have $300,000 to buy a house, the bank can lend you that. That's how they're able to lend that. This is a little tidbit of information for you there. But I'm going back to FHA and how to calculate FHA DTI. All right. When calculating the FHA debt to income ratio, you'll start with your gross monthly income. Like I said, you can go right on your calculator, right on your pay stub. I'm sorry. And you can see how much you make before taxes come out. It says it on your pay stub, gross monthly income. Now, if you're self-employed, you're going to be looking at your tax returns. And we can't use your gross monthly income. We got to use the net income that's shown on line 31. All right. However, let's get back to it. Then you'll add up all your required monthly payments that appear on your credit report. You see? This includes credit card minimum payments, car payments, personal loans, and other mortgages like a home equity line of credit, any second loans, construction loans that are put on your credit, anything that's put as another lien or loan against the house. Those all need to be factored in. Student loans as well. The only exception would be student loans since they are handled different. FHA does handle student loans a little different. So let me retract that. Student loans are required and included on conventional loans, but student loans are handled differently when it comes to FHA loans. That is correct. All right, here is an example of a debt to income ratio calculator. You can also use your DTI calculator provided at this article. You don't need to use theirs. You can use the one you have right on your phone. This isn't rocket science. This is constructive house science. You need to be able to be sufficient on your own and know how to utilize what's already right there in your face. Like I said, if we can go on social media and look up all sorts of non-constructive things, there's no problem. We're hopping on your calculator and just seeing it what your DTI is. These are things you should know whether you are or are not applying for a mortgage. You need to know how much of your money's going out versus what's coming in. You need to know that. I hear a lot of people say they're saving to get a house and they don't even know what their DTI is. Well, how do you know you're saving the right amount? How do you even know that you're able to get a house based on your income? You don't. So, gross monthly income, let's say it's $6,200, and the total of your debt obligations is $2,590. Your back end, which is your total income, debt to income ratio, is 41.7%. All right. Now, keep in mind, and this is a good tip here. When shopping for a home, the property taxes will have a significant impact on your DTI because that is included as well. Your taxes and insurance are included in what's called your proposed housing payment. So whatever your property taxes are and whatever your home insurance is will be included. Now, I've worked with a lot of different clients, and they'll say, well, I don't pay my taxes monthly, I pay them per year. Look here. The lenders you're talking to, the mortgage loan officers you're talking to are more than aware that your taxes are not typically paid every month. However, when you have an escrow account, they do collect for it every month to ensure that what's needed when it's due is there. Okay. So just to pull up our calculator again, so you can take a look here and see what's going on. What you'll do is whatever your annual taxes are, the proposed taxes, whatever your insurance is, whatever that amount is, you'll need to divide it by 12. Okay. So let's see. Let's pull this up again here because we want to break this down with you. And I'm going to be taking my time, but we're going to break it down. All right. So let's say your property taxes are 3,200 a year, right? Better yet, how about we do this? How about we do this? Because I like to make it look as real as it can be. All right. So we're actually going to do this. All right. Let's pick a house, any house. I'm going to pick any house. All right. Um, where I want to go? We'll go Jacksonville. We've been talking a lot about Jacksonville. Let's go to Jacksonville. All right. So let's pick up this house, 4 bed, 2 bath. All right, let's see what the taxes are. Well, it should show you that here. I may have missed it. Bear with me. Property details, yeah. Okay, no. Uh, Taxes. Here we go. So you go under property history. I like to use realtor.com. You can use Zillow as well. But you go under property history. You see the taxes here are $4,091. That was based on 2023. All right. So you're going to divide that. What was it again? 4,091. Divide that amount by 12. So you'll need roughly $341 to be included in that house payment. You need to add that to your debt to income because that's what mortgage lenders are going to be using. They're going to add all of that in there. All right. Same with your insurance, your homeowner's insurance. So if your annual homeowner's insurance is $800, then you need to be putting in $67 into your debt to income. This is how you ensure that you're prepared. This is also your ammunition in case you're dealing with a loan officer that is giving you misinformation. You can let them know, hey, I did my own DTI calculation and this is what I have. Can you show me what you're using? And this also helps you with that understanding because the goal here is for mortgage literacy. Okay. We do want everyone to be able to be literate when it comes to mortgage. But when you're looking at homes while you're dreaming away, as you should be, and you're putting these on your to do lists and your dream boards, go down here and look at these taxes. All right. See how much the taxes are in the house. Don't just look at the pictures of the home and say, this is what I want. That's one part of it. All right. Because keep in mind, the mortgage lenders, the banks are looking at your income, property, assets, and credit when it comes to completing your mortgage application and whether you're going to be approved or rejected. Okay. Now, a tidbit, just some tips, and we'll move on to the property side. Keep in mind total monthly obligations, including the housing payment, and that's property taxes and insurance divided by your gross monthly income. If you're applying with a spouse or a loved one, you need to have their information as well. That's their total obligations as well as their gross monthly income. That needs to be included to get your total DTI, debt to income ratio. Again, you want to ensure that debt to income ratio is lower than 45%. I know FHA will allow you to go up to 56.9. It will if you have other compensating factors, but you don't want to be right on the cusp. You don't want to be on the spectrum. You want it to be as low as possible. It's a measurement of what you have coming in versus what's going out. That's going to determine, that's what the banks use as their determining your ability to repay the loan. They want to make sure if they're going to lend you this money, that you're going to pay it back and they don't have to go and foreclose and buy back the home. They're not wanting to do that. And this is how they go. These are the steps they use to qualify to assure that they don't have to do that. So this is what your loan officer is looking for when they're qualifying for income. They're not looking to see how much you made. They are looking to see how long you've been in the line of work you are, because that can be a compensating factor to allow them to use a higher DTI. If you've been at that job for 20 years and your debt to income ratio is 48%, that may help because that stability there lets them know that you may have that ability to repay the loan. Okay. But of course, you still need other compensating factors. But yeah, if your debt to income is 47% and you're right on the spectrum, and let's say you got 3 months reserves, and we'll get into reserves too, because I'm going to show you some tips around reserves and how that can help you if your DTI is a little higher. Okay. But say you have about 3 months reserves. You can let your loan officer know because some of them don't know. I'm going to be honest. I've been in the game for 15 years. Some of them don't know, but you can let them know, hey, can you have this manually underwritten and let the underwriters know that I actually have been in my job for 25 plus years. My 401k is $400,000. So I have more than enough reserves in the bank that I can access. I have the ability to repay this mortgage. Can you have a manual underwrite completed for me? And they'll submit that. You have to request those types of things. If your DTI is at 55%, if it's at 55%, you can go an FHA route. You can request a manual underwrite. There's a lot of folks, especially my Department of Defense government employees, worked at UPS or the post office, which is government, and you've been working there for 15, 25 plus years, and you want to get a house, you want to get a house. If your debt to income is at 55%, but you have 300,000, most of them have more in your thrift savings plan, your retirement accounts. Those are strong compensating factors. Some lenders are not going to tell you, and it's not because they're literally looking to discriminate against you. And that's not always the case, although sometimes it could be. But a lot of times it's because the loan officer is unaware. They don't know that that's something they can do. It can be a little bit of a pain. It can be a longer mortgage process. But at the end of the day, it's getting the best fit situation for you. So don't worry about if instead of closing in 30 days, it takes 45 days. If that's what it takes to get you a house, you need to be taking those extra steps. If you're on the spectrum, always request a manual underwrite, because a lot of times you won't need a manual underwrite. That'll light enough fire in that mortgage loan officer's behind to go do it. And if not, there's other banks, especially mortgage company, non-depository mortgage companies. They'll do a lot of those loans. Mortgage brokers, they'll do a lot of loans like that because most of them are commission only. So if it takes them a couple more weeks to get paid, they'd rather do that to not get paid at all. So I mean, I'm gonna keep it real. Someone who's been on both sides. I've worked for banks, and I've worked for mortgage companies, and I've worked for brokers. I can assure you, I can assure you, if you're someone who's on a spectrum, if you're self-employed, if you're high DTI, it would behoove you to go to a broker, a mortgage company, someone who exclusively, an entity that exclusively only does mortgages. That's where you're going to get your better loan options. I know you may be comfortable with the bank that you do your checking, your savings with, but I'm here to tell you there are more opportunities with mortgage companies that only do mortgages, brokers that only do mortgages. They'll be able to give you wholesale pricing. They'll be which is lower rates, lower costs for the rate. They'll be able to they'll be able to use the maximum guidelines, where some banks have their own guidelines where it's okay, FHA says this, but we're taking it here. Where a lot of brokers, they're going to go off whatever FHA says. A lot of mortgage companies, they're going to go off whatever FHA says. So if they say 57%, they're going to use 57. Where I don't want to give out any particular bank because it may not be the case, but ABC Bank, which could be the biggest bank in the world, they may say all of our FHA files, we need a 38% DTI qualification if you want to get a mortgage with us. And there's a lot of borrowers out there that are like, well, I got denied from the bank, so I'm done. But you need to know that you have these opportunities here. There's banks that'll do exactly what FHA says. Mortgage companies, most times is going to be a mortgage company, a mortgage broker. A lot of your more traditional banks, they have tighter restrictions than even what FHA and Fannie Mae require, because they want their loans bought off the secondary market so they can lend out more money. And if they're able to say, hey, we have guidelines stricter than yours, the secondary market is going to buy those with no problem. So that's why they do that. Does it indirectly discriminate on a lot of applicants? Absolutely. Absolutely. Because you're leaving out a lot of folks and not giving them that education that, hey, you can actually still get a loan. You just can't get a loan here. So folks will walk off, leave out the bank, get off the phone thinking they don't qualify. Now, I did want to also pivot back as it pertains to income, because this is information that you need to know. If you're a self-employed by borrower, you're buying a home, and let's say that you're showing on your tax returns that you make $45,000 a year for both years. All right, I believe that's what gross monthly income is $3,750. All right, you're gonna need reserves in the bank. You're gonna need about 12 plus months. I'm just gonna keep it real with you. You're gonna need about 12. The more months you have in the bank, the better. And it will behoove you to have a co-borrower with you, preferably one that's not also self-employed. But if they are, you all combined are going to need at least 12 to 24 months of income in the bank if you're showing that little that's, I don't want to say little, but if you're showing that type of income to reduce the amount of taxes you have to pay or to gain a refund, whatever the incentive is for you to show that, you're going to need reserves in the bank. Now, if you have a retirement plan and it has 400, $500,000 in it, you're well on your way. Now, most banks, if it's an active retirement plan, they're only going to utilize typically about 85% of what's showing there. So let's say you have $550,000 in your 401k. They'll use about 467,000 of that. Now, let's say your mortgage payment is going to be $2,800 a month. Divide that by 2,800. All right, you got reserves that can be used. You see that? You got reserves that can be used. You got about 167 months worth of reserves. But your more traditional banks don't typically deal with those type of portfolio products because the secondary market can be hesitant to purchase those. If they'll purchase them at all, they're usually portfolioed, and that's just the bank using their own money to lend to you. So that's why a lot of your traditional banks steer away from those. But that's why you have mortgage brokers and mortgage companies that you can lean on to get those, especially if you're a lawyer. And let's say you have a you were working with a law firm for X amount of years, they had a retirement plan, and you decided to start your own private entity. All right, but on paper, maybe you're showing 80,000 a year, you know. So 80,000 a year, that's about 6,700 a month. All right. But you want to get you a decent house. You work real hard, went to law school, undergrad, the whole nine. You've been putting in work, maybe as a public defender. You worked for another law firm for 12 years. You've been putting in a lot of work. You want to get that $580,000 house. All right. But you got that retirement fund, retirement plan, and it's got about 600,000 in it, right? You have the reserves. You need to be checking in with different mortgage companies, and you get what's called a bank statement loan. You get what's called a bank statement loan. They offer them, especially brokers. They offer them, and if you can show that type of reserves, that's going to help you. And I guess I'll go ahead and segue into the assets part. I did want to discuss property, but we'll go into assets, okay? Because it's all a working train. It's all working together. You need four pieces of the puzzle: income, property, assets, and credit. As it pertains to income, banks are looking at your debt to income ratio. We'll go into assets because if you're on the spectrum, if you're on the spectrum, if you're tight, you're going to be considered higher risk when it comes to mortgage qualifications. If you're above 45%, the banks are already looking at it. Okay, it's a risky foul as it pertains to income. So, do you have the assets to kind of balance that out, like a seesaw? All right, your DTI is high. Can your assets kind of balance that out? Can your credit balance that out? Can your equity, your loan to value balance that out? So let's get into assets because a lot of folks don't know that there's other ways, especially my first time home buyers. They don't know, they don't know that there's other options to get closing costs covered. There's other options to get down payment help. They're only looking for down payment assistance programs, and those aren't always going to be your one all be all solution, okay? Because I'll tell you here, one of the most common things, especially with first time homeowners, some with those that have owned homes in the past, one of the most common things people think that they have to pay out of pocket is down payment. And they feel like if they get a loan that has zero down, that they shouldn't be spending anything out of pocket. And a lot of folks forget that there's a thing called closing costs because everybody involved in the loan, they're not working for free. Okay. You got the title company who has to record your deed with the courthouse, they have to schedule and arrange your closing. They're not doing that for free. Those fees are passed to you. All right. Because you're the one buying the house. All right. You got your loan officer. They're not working for free. You got the banks. Those are all a part of closing costs. Government fees. Yeah, you got to pay government fees to buy a house because they're recording your deed. They're going to be doing a whole new, well, not a new survey, but they'll be putting in a new title insurance policy, your owner's title insurance policy, your lender title insurance policy. All those are a part of closing fees. Okay. Or as they would call settlement cost or investment cost is what I like to call them when I'm working with my clients is an investment cost because that's the investment to you buying a home. You have to give some more money. Now you want to keep those costs as low as possible, but those are all included in out of pocket expenses, which you need to show the assets to ensure you're able to get the mortgage, especially when it's a purchase. A refinance, you already have the home. So assets are reviewed and utilized, but not in the same way on a purchase. Um, Not in the same exact way. It's very similar, but not the same exact way. So when you're buying a home and there's a down payment, or let's say there's zero down, you still have to show asset statements that can be retirement plan, that can be bank statements, that can be stocks and bonds that show that you have the money to cover the out of pocket expense. Sometimes closing costs can be $15,000. So let's say you get a house for $550,000. 1% of that is $5,500. Closing costs sometimes can be 3% of the loan. That's 16.5. That is realistic. That is realistic. That you're still spending $16,500 for a $550,000 house and you haven't paid any money down. Now, let's say you're getting an FHA loan. And let me pull up my calculator again so you can see that just on a basic calculator because I'm a hands-on learner, so I like to see it and go through it as someone's teaching me. I like to do that. I'm not sure if everyone else is that type, but let's take a look. So $550,000. Matter of fact, let's make this the whole screen. $550,000, right? Hold on, where'd it go? All right. Times minimum FHA down payment is 3.5%. All right, so you're gonna need 19,250 for your minimum down payment. Okay. Now let's add that 16 grand for closing costs. All right, so you're gonna need roughly $36,000. Now, do you have that in the bank? Some folks that I work with, they do. I'm gonna be real with you. Some folks I work with do have this and more. I'm gonna keep it real. I'm gonna keep it real. I'm gonna keep it real. But if you don't, do you have this in your 401k? Do you have this as it pertains to a sum of both? Like, do you have maybe 8,000 in the bank and 22,000 or 25,000 in the retirement? Let's say you don't. Let's say you're working with me, and which this has happened to me before. Hey Tim, hey man, look, I don't have a retirement. I don't have a retirement. I only have about $3,000 in my bank account. I got a 712 credit score. My debt to income is 40%. Why can't I get this house? Y'all can't just roll that in? And these are the tough challenges or challenging moments in this business. But I will tell you there are ways to roll that in. And we'll discuss that on the property portion that we'll get into later. However, rolling that down payment in, I'm going to tell you, not likely to happen. But rolling those closing costs in, That can happen. I'll break down how you can do that. See, we're going to unveil some of the tips and codes and things that people aren't aware of, but I'll show you that. Now, one thing I do want to tell you, if you don't have the money in the bank, liquid, you don't have the retirement funds, there are other ways. One way when it comes to assets is if you own another property, you can use the equity out of that property as a down payment or to pay the closing costs. You can pull the equity out of that property. Say your parents left you a home or left it to you and your brother and sister, and your name's on it. You can take a loan out against that with that same loan officer you're working with. You can pull a home equity line of credit. Let's say maybe it just has $60,000 of equity in it. You can pull some of that equity out and apply it towards your down payment and closing costs. Yes, you can. You can get a home equity line of credit, pull on that, and voila, now you have the money right there at your fingertips. That's why you need to check out my redlining stream I did, where they actually squeezed out Black and non-white communities from having those types of opportunities due to the HOLC's redlining maps, where they devalued the homes in those areas, which put them in a position where they can't do that. A house they bought back in the 30s for $5,000 that now on the other side of the tracks, other side of the river, those homes quadrupled. Their homes quadrupled the other way, going down. It started being worth only $500. So they didn't get that opportunity. But if you are in a position where you have property, not just a home, let's say you own a boat free and clear. Let's say you own a car free and clear. It might be a 2010 Escalade, but if there's no payment on it, it is an asset. It doesn't have any loan on it. It is an asset. It may not give back as much value as you would like. Maybe you only can get 7,000 for it, but that is money that you can use and leverage towards your mortgage. If you want to trade it in, even take a loan out against it. That's not something I would advise as far as taking a loan out, because that loan, if it's going to be done on credit, will be included in your income profile. They're going to roll that into your DTI. But if you are, you got 2 and 3 cars and that's one that's sitting in the garage, it runs fine and it doesn't have any payment on it, your assets are not where they need to be to qualify, because you need to show that you have those funds for out of pocket expenses due at closing. That needs to be shown prior at point of application that you have that. So that way you're not wasting your time and you're not wasting the bank's time. But if you need 7 more thousand or 10 more thousand, whatever it's worth, and that can get you there, you may want to take a look into that, because you need to show that you have the funds to pay out of pocket at closing, especially for a purchase. Now, another option that you can take a look at, let's say that your family did not leave you the house, right? Let's say your dad, mom, grandmother, whomever, say they are living in the house and they have equity in the house, and you've been a good grandchild or a good son or daughter, they can do what's called a gift of equity. They can pull out their equity in the home and gift it to you. They can give it to you. They fill out a letter that's called a gift of equity letter. They'll take a home equity loan or do a cash out refinance against their own property. They get the funds, because when you do a cash out refi or a HELOC, you can pull those funds. They can use those funds and give it to you for your down payment or out of pocket expense. And the reason, I know some folks say, well, I can just do that without going through the banks or without filling out a gift of equity letter. What do I need to do that for? I can just ask them for it. You can, but if you're looking to be qualified at that point in time, you'll need to do the gift of equity letter. And the reason being is, if you're getting a loan that's going to be Fannie Mae or Freddie Mac, and you send in those bank statements, those asset statements they need to show that you have the funds to pay out of pocket at closing. If they see a big old deposit from grandpa for $50,000, they are going to deny your loan because of the Patriot Act. It appears that you're laundering money, although that isn't the case. That's why you have to fill out the gift letter so they can trace that. Now, on FHA and VA government loans, they'll also need to show the bank statements from the family member that gifted you the money, because gift of equity can only come from those that are in an arm's length of you. Or not, I'm sorry, I said that wrong. Non-arm length. So family member. And what they mean by arm's length is those that aren't family member, they're not arm's length of you. They're not someone you're hugging. It's not your friend at work, your boss at work giving you equity. They wouldn't consider that someone who is non-arm's length. Non-arm's length is someone that you could hug. That's how they look at it. Someone you could put your arm around. Your mom, your dad. Those are non-arm's lengths. It's not back up, get away. It's not your coworker. It's not your boss. It's not somebody that you know from down the street. It's someone that you could actually hug and not get sued for. Okay. Non-arm length transactions is what gifts of equity are for. And say your grandmother or your father or mother, they live in the house. The house has 100,000 in equity. She can gift you, he can gift you 50 grand of that to pay your out-of-pocket expenses. Some folks don't know that they have that opportunity. And there you go. Assets, now you qualify. Because as it pertains to assets, you want to have about 3 to 6 months reserves in the bank. But if you're buying a home, you need to have your down payment and closing costs. And I'm going to keep it real with you. If your debt to income is high and your credit is bad, you're going to need your down payment, your closing costs, and at least 3 months reserves in the bank to balance that out. Is it always required? No. FHA is a little more loose on that. But if you want to have a strong profile, these are the steps you'll want to take. This is what underwriting's looking for. And they say your loans and underwriting, they're looking at these factors. All these compensating factors matter. All right. It's not just, oh, I got enough for the down payment in the bank. If the closing costs are $13,000 and you don't have that in the bank and all you have is the 50 grand you're putting down, you're going to have a little bit of a problem, especially if the 50 grand is 3% or some minimum down payment option. You're going to have a problem. All right. Now, what some folks aren't aware of that you can use, as I was discussing earlier, one is a gift of equity. And again, that can only be from non-arm length transactions, family members, in-laws, uncles, aunts, those types can gift you equity. So think about that. If you got an uncle who retired, got a good amount of money, you think about that. Now, the thing with a gift of equity is the reason they'll sign a letter is they're saying it's not a loan. Okay. It's not a loan, that they're gifting you this. Now, whatever you and Uncle Jim or Dad or whoever, whatever y'all do on the side is up to y'all. If you want to pay him back and give him a gift back, the bank doesn't need to know about it, and you don't need to write that in the letter. But you're not supposed to lend them the money. They're supposed to gift you the money. Okay. And they can gift equity through HELOC, sale of another home. There's some folks that you may have a home in the family. You can pull off of that equity too. It's just whoever's on the estate, whether it be your uncle, cousin, whomever, they need to fill out the gift of equity letter. Matter of fact, let's pull up a gift of equity letter so you can kind of see what it looks like. Let me see if I can find one. They're out there. They're all over the place. And it doesn't have to be super official. Most lenders are going to provide you one because they want to make sure it covers everything. But it needs to cover that it's not a loan. Of course, it'll need both of you guys' name, addresses on there, the amount they're gifting you. and that it's stating that it is in fact a gift and not a loan. Um, a FHA, your family member will need to send their wherever they're getting that money wired to. So say they pull out HELOC for $50,000 to cover your out of pocket expenses. And when they pull that out, the HELOC funds are deposited in their checking account. They'll need to show their 2 months bank statements that reflect that deposit. Wherever that money is being deposited to, FHA requires that they do show the bank statements. Now, Fannie Mae and Freddie Mac, to my understanding, they still are not requiring on a gift of equity that they show that. They just have to fill out the letter. Okay? They just have to fill out the letter. Let me see if I can find the letter. I want to find a nice looking letter. You know what I mean? Um oh my word. You gotta go through 100 ads before you can just find what you're looking for, man. It's crazy. Um well, here's one. Let me pull this up for you real quick. Here's one. Um Thought I had it pulled up. Let me X some of this stuff out so I can find out. Oh, all right. And we'll just look at the document as a whole so you guys don't got to look at me. But as you see, here's a gift of equity letter. Okay, you'll put your name or the name of donor, address. Like I said, you got to put the relationship because they want to ensure that it is a non-arm length transaction. It's somebody who's a close relative. All right, and that can include in-laws. Okay, the recipient of gift. They're gonna put your name here. That'd be the recipient. All right, will give or have given him or her a gift of equity in the amount of. I'm gonna put the amount. This is a bona fide gift, and there is no obligation, express or implied, to repay this sum at any time. These funds are available and will be given to them and will be given to recipient of gift. You're gonna put your name again. On, you're gonna put what date it is. To close a mortgage transaction on the purchase of his or her new home. The funds of the gift or the funds which are or were given to the home buyers were not made available to the donor from any person or entity with an interest in the sale of the property, including this letter, including the seller, real estate agent, broker, builder, loan officer, or any entity associated with them. See, these are all people who would be at arm's length, but it can't be anybody involved in it. It can't be anyone involved in it. Okay, it can't be anyone involved in it. But this is another way where you can tap into other assets. So if you do have a family member that owns a home, and you all are close, they may or may not be aware of this. That they can help you out with getting a home, even though they don't have the money in the bank. All right, all right, and it's a gift of equity. Okay, they can also give a traditional gift. So say your dad's been working at the plant for X amount of years, right? 30 years. And say he has 700 grand in his retirement fund. All right. And he wants to give you a gift. He can pull and take a loan out or just cash out a portion of his retirement and give that to you as a gift for a home purchase. He still has to complete a gift letter. Okay. These are just other alternatives you can use to actually purchase a home. Say you only need to take out 12,000 just to cover the closing costs. You got a zero down payment first time home buyer loan. You found some grant or any other way. Maybe you're a vet and you get it zero down because you're a veteran, but you need the closing costs paid. And you have to show that you have the money in the bank in order at time of application. Because when they're submitting your application, you need to provide your supporting documents. And part of those supporting documents for assets is 2 months bank statements or your retirement fund or your stocks, whatever assets that you'll be using. And if it's going to be a gift, you have to complete a gift letter. And again, if you're doing a government loan, the bank statements or asset statements that were used to give you that fund, those funds need to be produced. So if a family member is going to help you out with a using maybe their retirement or using their own just liquid funds, they have to produce the bank statements, the source of funds. Those statements have to be produced. And it's a 2 month look back. So if they're getting retirement quarterly statements, they need to send in that quarterly statement. All pages, nothing blacked out, along with the gift letter. That shows that it's a gift and it's not going to be repaid, when they'll be giving it to you, and producing the supporting documents to reflect it. Because saying it isn't enough. You can tell, but you got to show and tell. Okay, so keep that in mind. It's showing and telling. So these are other assets, other options to use assets. One big one that I use that a lot of folks aren't always familiar with is retirement, because a lot of folks who actually leverage their 401ks, their thrift saving plans, their 403bs, who are leveraging those appropriately, their pensions, they may have enough money to cover the closing costs and down payment, but they're only looking at checking and savings, and some mediocre or just unfamiliar loan officer may not make you aware of that you can actually use your retirement. And like I said, you can typically, I believe it's 85%. Banks have certain guidelines and restrictions on how much they can use. But just keep in mind, if you have quadruple the reserves. Now, one thing I always ask folks when I'm doing a mortgage is how much do they have in retirement? And sometimes it can be an uncomfortable question because they're like, I just met you 30 minutes ago. You're already all in my business. But keep in mind, the whole point is taking the application to go over your ability to repay the loan. It's about your ability to repay the loan in the income, property, assets, and credit sections. And assets is a major player, especially when you're purchasing a home. You have to be able to show that you have assets to buy the home, that you have reserves in the bank. Keep in mind, and this should just be a rule of thumb in general, that you would want to have 3 to 6 months of reserves, house payments in the bank when you have a home. Because if anything were to happen, you need to be able to at least give yourself 3 to 6 months where you can still pay bills. Let's say you lose a job, and it may take you that time, maybe more, to find a new one. But at least you know you have a few months to carry the boatload. So that should be a rule of thumb, just off general principle. But banks look at that as well. Lenders look at that as well. How many housing payments do you have saved up? They also look at, do you have the funds that are needed out of pocket to actually close the loan? And that's your down payment and closing costs. Those are out of pocket expenses. Your 401ks, your retirement plans, those you actually, in a lot of cases, can leverage those without getting penalized by the 401k holders, the retirement holders, because you're buying it for a house. Typically, you have to show them your loan estimate. You have to show them that you're going through a loan application. And usually, they want to see the loan estimate, not just the uniform residential application. They want to also see the loan estimate, so that way you're not being penalized for cashing out earlier or for taking a loan out against your home, or against your retirement. I'm sorry. So yes, the goal is home ownership. So you usually will have favorable terms when it comes to leveraging your retirement plan in order to pay your down payment and your closing costs. A lot of folks don't know that they can leverage their retirement. Some don't want to, but if you really want to get a home, and you should, because that's one way that you can pass down generational wealth. Like I said, you were able to give that gift of equity to your children at some point, and be able to leverage that as a financial vehicle, and your house can be an asset to you. But if you're wanting to do that and you don't have the closing cost in your checking or savings, and you don't have grandfather, uncle, mom, dad, whomever, you don't have that in order to pay your down payment and closing costs, then but you have it in your retirement, you can leverage that. You can leverage that. Because keep in mind, if you're using your home as a financial vehicle, even though what you may have lost a little bit in your retirement, you're going to be building another asset with the home ownership. Because if you're buying a home, which I would suggest you do, that's going to improve in value, increase in value, then you'll be making that up with your home. And if you just took a loan out against your retirement, you'll be replenishing that account anyway. And you'll be making now you have two investments going on. You got assets because of the ownership in your home, and you've replenished your retirement account. So I would 100%, and a lot of loans that I do with clients, they typically are using their 401ks or their retirement plans, and they leverage that asset for their down payment and out of pocket expenses. So bringing up the calculator again, let's say, and we're just talking about asset qualification. All right. We're just talking about asset qualification. We'll be going into loan to value, and we'll be going into credit, but credit's pretty straightforward. So we won't be spending a lot of time on credit. Just going to be real with you. I know that everybody thinks they need to be worried about their credit score, and they fail to realize if you have an 800, but your debt to income is 85%, you're not getting approved. It doesn't matter that you have an 800 credit score. That is only one piece of the four-piece puzzle. You need more than just credit. You need more than that. Matter of fact, I've done mortgages with folks with 585 credit scores, and I've gotten them new houses. 585 credit score, but they had reserves in the bank. They were able to make a down payment, and their debt to income was low. Their credit was bad because some of them, they fell on hard times at one point. Some of them may have gone through a divorce, whatever the case may have been. They may have owned a business, it didn't turn out right. They started working, pay stub W-2 job. Now they got the money, but the credit is still a work in process. Those things happen. But guess what? Their other compensating factors were strong enough that it overcame that 590 credit score they had. Because FHA will let you go down as low as a 500. So when a lot of folks are saying they're just working on the credit and they're not working on their DTI, they don't have the reserves in the bank. They're looking for zero down payment. Your compensating factors aren't there. So having a 750, yeah, that's good. It's a nice trophy. But keep in mind, it's a trophy. That's just a trophy, man. There's four pieces to getting qualified. They're not just gonna. I've done mortgages a long time, well over a decade, but really pushing two, to be honest. And I've never saw someone who had high DTI, high LTV get approved because they had an 800. I've never done that for anyone ever, and it'll never happen. It won't. Have I run into applicants like that? Yes, more than you'd ever know. I've run into a lot of applicants with 760s, but very high debt to income. They're paying their bills. That's why their credit's good. But the credit bureaus don't know how much money you make. All they know is you're paying your bills. Now, the mortgage company knows. We're like, okay, you can pay your bills on time. That's good. But if we add this mortgage payment on here, you're not going to be able to pay that. And that's what usually hurts a lot of folks. Your credit's good because you're paying your bills. So in their mind, and I understand that rationale. Well, I got good credit because I can pay my bills. I just need y'all to give me a loan so I can get a house, and I'll pay y'all bills like I'm paying those. And it's like, well, you're earning 3,000 a month. Your credit bills are 1,800 a month. You're paying that. Now, if we add on a $3,000 mortgage payment, your obligations are more than what you're bringing in every month. You can't buy the house. You literally won't have the money. And they're like, oh, I'll figure that out. All right. Send me the supporting documents. You can't just tell someone that. You have to send the supporting doc. Show where that other income's coming from. If your girlfriend's going to be helping, she's going to have to apply too. It's those things. So don't think just because you have an 800, banks give you the go ahead for everything. That may be the case for auto loans. That may be the case for credit cards. But when you're buying a house, which we've talked about before, that's a way where you're able to generate generational wealth. The guidelines are different. They're different because the government is well aware that that can actually turn families from struggling to wealthy very fast if you know what you're doing. And I'll be going over and breaking down how you can know what to do with that. But one piece alone isn't going to get you qualified. Having a good income and poor credit, poor assets, poor LTV, that's not going to get you the loan. Having great credit and all the other three are poor won't get you the loan. Having the money for the down payment, but you got poor credit, poor debt to income, it's not going to get you the loan. All four have to work together. They have to support and compensate each other. So and I'm going to wrap up the assets portion, but when it comes to assets, utilize and leverage your retirement accounts. And these are things you don't have to uncover them in full detail at the onset of application, but let your mortgage loan officer know, hey, I got 400 grand in the retirement in all my accounts. Hey, my dad will give me equity, or my dad will send me a gift. Remember, you can use a gift of equity, or you can get a straight gift where they're just giving you cash. But if your family member doesn't have the cash, but they have equity in the home, they can give you that. Now, keep in mind, they have to go through a mortgage process too in order to leverage that equity so you can have the qualifying assets. It would be in your best interest to have them do the mortgage with whoever you're doing your home purchase with. That way, it can close on time and be simultaneously, so you're not working with a whole nother loan officer, a whole nother bank, and going through all their rules. The one you're dealing with can go through step by step what's going on. That's the best way to go about it. Now, a lot of times I've been in a situation where grandpa doesn't want to deal with me, don't know me. He know the folks at the credit union, and that's the only ones he working with. Has it been a pain? Yes. But can you still do it? Yes. But what is easiest is to have them work with the same loan officer or loan originator that's doing your home purchase. That way they can ensure everything is smooth. Because if there's any hiccups, they'll be on top of it. If there's not enough equity, because they'll have to more than likely get an appraisal. But if it's a home equity line of credit, maybe not. But you want to make sure everything is where it needs to be. Keeping that all under one roof makes it easier for you when you're buying a home. Okay. But again, you can get a gift of equity. They both require letters to be completed by you and by the gift donor. All right. If it's a government loan, they'll have to provide their asset statements. If they're giving you a gift, they'll have to provide that bank account or retirement statement, whatever asset statement. They're going to have to provide 2 months history of that in order for that to be qualified assets. They'll have to provide that along with the gift letter. Keep that in mind. If they're doing a gift of equity, they're going to, if it's a government loan, government is FHA, VA, or USDA. If it's a government loan, they will need to provide the gift of equity letter signed by you and by the gift donor. If it's grandpa, grandma, uncle, cousin, whomever, again, it could be non-arm's length, close relatives. They have to provide The 2 months bank statements or asset statements of wherever that equity was deposited to. So if they did a refinance cash out and put it in their checking account, they got to send the bank 2 months of that. If you're doing a FHA, VA, or USDA, they have to send that. Fannie and Freddie, they only require that you fill out and complete the gift letter. Okay. Conventional doesn't require that. All right. So this is how you have qualified assets. This is for those who need to show the down payment, those who need to have the funds to close. These are some alternate options you can use in order to be able to qualify on assets. These are some options you can use. You can use your 401k, 403b, thrift savings plans. You can tap into that and use it. Like I said, you can take loans out against them and not be penalized. You can pull out against it and not be penalized for early withdrawal if you can show that you're doing it for a home purchase. And the way you show that is you submit them. Some will accept the 1003, but they usually want a loan estimate, which is what you get after you complete your uniform residential loan application, otherwise known as a 1003. Once you get your loan estimate, you send that over and they'll make sure that you're not penalized for that. All right. So remember, you can use your retirement account because there's a lot of folks I work with. They're like, I don't have $27,000, Tim. And it's like, well, do you have a retirement account? Well, yeah. Yeah, it's $80,000 in there. Well, you can use the 27,000 for the down payment. You can use that. And you won't even get the early withdrawal penalty because you're doing it for a home. You can do that. And I've seen smiles turn upside frowns turn upside down because they weren't aware. They're like, I don't have $27,000. Now I've had some that don't want to touch the retirement because they're not really understanding the value in owning a home and having your retirement account. But to my youngins out there that don't want to see money coming out of your check, you need to be putting money into your 401k or retirement plan, especially if the company's matching it. There's no reason to not do that. That's how you're able to get these types of things accomplished. There's no reason to do that. If they're matching 3, if they're matching 6%, you need to be putting in 6%. And they're putting in 6, that's 12% of your check going into your savings account. That's all a retirement account is savings for when you retire. And you can use that too as a vehicle, just like your house. You want to accumulate as many assets as possible. We're on the asset portion. You want to accumulate as many assets as possible. A lot of people talk about crypto, different stocks and bonds. Look, these are easy ways to accumulate assets. Okay. And it does require you knowing all sorts of coding and stuff like that. I'm telling you right now, here is the game plan. You own a home, you buy it in a substantial, sustainable area where it's going to increase in value. Now, say you bought a home for $500,000 and it's worth $600,000, you have an asset of $100,000. Did you hear that? $100,000 that you have access to. You own that. That's yours. That's your money. You understand? You buy a house for $200,000 and in 3 years it's worth $225,000. You now have $25,000. Do you understand? Those are qualified assets. Keep that in mind. Keep that in mind. Home ownership is the way to help generate generational wealth. Is owning homes. Okay? I've worked with a lot of applicants where they already know the game. They're like, yeah, my dad's going to gift me $12,000 and my grandma's going to give me a gift of equity of 20 grand. They're not paying, the children aren't paying anything out of pocket. They got a brand new house. Brand new house. They didn't pay anything out of pocket. So it's time to soldier up and start working towards these things. But as far as assets, like I said, you want to make sure that you do have 3 to 6 months reserves, just as a rule of thumb, because this will be strong compensating factors if some other areas are not as strong as they need to be. All right. You also want to make sure, as far as your checking and savings account, these are things you want to also be aware of as it comes to pertains to qualifying assets. Any large deposits, and that's any cash deposit that's more than half of your check, more than half of your gross monthly income, they will be flagged, and you will need to provide a letter of explanation to the lender as to what happened and what is that about. And that's the Patriot Act. So keep that in mind. Now, a way around that is you start your application after that money has been in the bank for 60 days. So if you get a large lump sum put in there, maybe, and I'm not encouraging any mortgage fraud, but maybe grandpa's like, look, I'll give you 60 grand for your down payment, closing costs, but you're going to have to start paying me back. And he puts that money in your bank account, you can't take a mortgage application for at least 60 days. Okay. If you do, they're going to have to show proof of that. He's going to have to fill out that gift letter. You got to do all of that. All right. So keep that in mind when it comes to qualifying assets. You don't want to have any NSF overdraft fees on your bank statements. Okay. When it comes to qualifying assets, FHA is real harsh on bank NSFs, insufficient funds. You don't want any. Okay, no insufficient funds. If that's happened in the last 30 days, wait 2 months. So now you got a new bank statement history to go off of. You don't want any of that. No insufficient funds, overdrafts. Okay. All right. So you want to make sure you don't have any insufficient funds, no overdrafts, no large deposits. These are things that underwriters are looking for, in addition to you having the funds to close. Make sure you don't have any under NSF fees on there. Bounce checks. All right. No series of large deposits or even just suspicious deposits that are hard to explain, or someone just keeps giving you $100 every other day. It's going to look suspicious. They may think that you're selling narcotics or selling something. All right. So make sure you're paying attention to that, because when it comes to qualifying you on assets, those can get in the way, especially the return checks. Those can definitely get in the way. Make sure the bank statements you're submitting when it comes to qualifying assets, make sure those are the bank statements that have your paycheck in them. Make sure wherever your paycheck, if it's direct deposited, that's the bank statement you should be using for your mortgage qualifying assets. You should be using that bank statement. Okay. But no insufficient funds, bounce checks, return checks, no large deposits, and that's large cash deposits. You get a tax refund for 12,000. It's going to say IRS on there, so they can trace that. It's on the bank statement. But when it just says cash, 12,000, and you only make $5,000 a month, yeah, that's going to be a red flag. It's going to be a red flag. That's more than your income. That's double your income. And somebody just put cash in there. Yeah, they need explanation for that. It's called a letter of explanation. And that's a way around it when it comes to qualifying for assets. But that letter of explanation, let's say you say my grandfather gave me that as a gift. Now, grandpa's going to have to fill out a gift letter, not gift of equity letter, but a gift letter. And in that gift letter, grandpa is going to have to say that it was a gift, it wasn't a loan, his relationship to you, and signing when he gave it to you. And if it's a government loan, he's going to have to provide his bank statements, whether it's 2 months of his bank statements, checking and savings, or whether it's his retirement account or some annuity account. He'll have to show those statements, a 2-month history of those, if it's a government loan. Okay, keep that in mind. That's how you qualify for assets. So you can use some non-traditional ways to qualify for assets. Like we mentioned, the gift of equity, gift, 401k, 403b, your thrift savings plans, retirement accounts can be used. Yes, stocks and bonds can also be used. You want to make sure that it does show that you have the amount on your loan estimate, that it says funds due at closing. If it says 32,000, your bank statements need to show that you have the 32,000. Your gift of equity needs to show that you'll have that 32,000. It can be a portion from your checking, and then the rest will come from grandpa or dad. It can be a portion from the gift of equity, and the other portion comes from your 401k. You can mix and match, but it needs to show that you can cover that amount. Now, if you're on the spectrum on DTI credit, you also want to have 3 to 6 months reserves. Again, reserves is your housing payment, that amount sitting in the bank. That's a rule of thumb. It's not the end all or be all, but that helps a stronger profile. Now, to my self-employed folks out there, if you're using your assets as to qualify your income, you're going to need even more assets to qualify your assets. So let's say you're using your assets to qualify for your income. You can't then also use those same assets to qualify for your down payment. Those are used on income. Now you need a new set of assets to use for your down payment out of pocket expenses. But being self employed doesn't restrict you from being able to use these. The gift of equity, the gift, you can still do all of those things. So make no mistake, you can still use that. Like I said, there's some lawyers, doctors, may have worked at a hospital, decided to run their own private practice. They want to get a house. They got a retirement plan that has enough. You want to take the mortgage broker route, speak with a mortgage broker or a non depository mortgage company and see how they can do a bank statement only loan. You want to take a look at that, especially if you have a retirement in the millions, which some doctors and lawyers do. But liquid, you may only have enough to cover your down payment and some little extras. Yeah, you want to use that. Use that. Tap into that. I know you might not want to, but if you really want that house, tap into that. You can get around those tax penalties for early withdrawal. You can get around that. All right. All right. So next we want to get into property. And what banks are looking for and lenders, what they're looking for on the property side of things are your loan to value. That's what they're qualifying you for. That's what the underwriter, when they say, oh, your loans and underwriting, they're looking at your loan to value. There's other factors, but the main thing that they're looking at as far as what determines risk is your loan to value. Okay. And your loan to value is your loan amount versus what the home is valued. Loan amount divided by home value. All right. Now, when you're doing a home purchase, okay, and let's share the calculator again. When you're doing a home purchase, and let's say you're buying a home for $500,000. All right, and you want to put down 20%. That'll be 100 grand. All right, so your loan amount would be 400,000, and your value is going to be 500,000. All right, that gives you an 80% loan to value. Okay, you have $100,000 of equity in the home, which in this case would be 20% equity. Banks, their rule of thumb is 20% or more is in the green. You're good when it comes to loan to value estimate. So think about it. We see a lot of homes that are $500,000 homes. In order to be considered less risky, you need $100,000 to buy that house. So let that sink in and process that. That's where banks are saying, all right, this is not a risky person. And they want it as lower under 80% as possible. Okay. But a $500,000 home, you're going to need about 100 grand to have a 20% down payment. All right. Now, let's say, how much was that house we just looked at? Let me pull that up real quick. Because I believe the home we were just looking at, it wasn't that much. By that much, I mean it wasn't 500,000. Yeah, it was 189.9. All right. So, and let me share this screen real quick. Well, actually, so let's take a look at this one. Okay. Let's take a look at this one. All right. So on this home here, it's 424,000, right? It's $424,089. It's in Jacksonville, Northeast Jacksonville. Okay. It's not bad. All right. These look like some AI photos though. It's not doesn't look real, so I'm assuming they're just building it. I don't know. But they're estimating the loan payment would be 2,845. That's interesting. But yeah, that's based on somebody, I'm assuming, putting down 20%. So here's a breakdown right here. This is why I do like realtor.com. I believe Zillow does it also. But the interest rate, they can't stand on that. They can't stand on 6.6. It probably is in that ballpark, but they can't stand on that. You need to speak with a real mortgage loan officer to verify that in real time. Okay, because the mortgage rates change throughout the day. So you want to verify that in real time. But taking a look here, right? Um, this is the purchase price, 424.89. Interesting. But to put down 20%, this would be 84,818. So we're gonna round that up to $85,000 you need to put down. All right. And you see total due out of pocket. They're estimating 101,782. And that's for buying a $424,000 home. All right. This isn't for a mansion. You need $101,000, roughly 102,000. Estimated closing costs, which is that's pretty accurate. 4%. That's 16,964. $17,000 in closing costs. All right. So inflation isn't just hitting the grocery stores, it's in the mortgage market too. All right. Now, this is if you wanted to be considered a strong profile and put down 20% or more. All right. So let's look at what that LTV would be, which it should be 80, but loan amount 424. Well, this is the purchase price. Mine is 84,818. So the loan amount that you'll be working with would be 339,271. All right. And when you divide that by 424.89, you get 80%. That'll be your loan to value. Now, let's say on this house, you're looking at doing a 3.5% down payment, right? You're gonna do 3.5%. It's $424.89. And you want to do a down payment of 14 four, you'll be looking at a down payment of $15,000. Okay. $15,000 to buy this house. That's a minimum payment, $15,000. And your LTV is going to be 96.5%, which is going to put you more than likely in the FHA zone. It's more than likely going to put you in FHA to buy this house. And you'll still need 15,000, and the closing costs are still going to be the same, if not more. So let's do the math. 15,000 plus 17,000. You're going to need $32,000 to get this on FHA. And that's estimated, but you need about $32,000. All right. You need about $32,000. Okay. And this is in Jacksonville, Florida. This isn't in Los Angeles. This isn't in San Francisco. This isn't in New York. You're going to need $32,000. $32,000 out of pocket, roughly. You'll probably need a little bit more than that. Your payment is going to be a lot higher than this because you're not putting 20% down. So the less you put down, the higher your mortgage payment will be. All right. It will be higher. And we can break down how much higher it'll be if you all want to look at that. That's perfectly fine with me. Perfectly fine. If you want to break that down, we can look at that. There's no problem there. We can break that down. Let's see if I can pull that up for you all. All right. Let's take a look here. Can I use this one? I don't typically like using this. Here's what we'll do. Let's pull up mortgage. I like to use my own mortgage calculator, but I'm not gonna lie, my battery on it is out and just haven't gotten around to get another one. But I have a tool that I'll be showing you all soon that we can calculate that rather swiftly. All right. So how much was that house again? We'll just say 425. It's all that $89 jazz. It's whatever, man. All right. So let's take a look here. 425. We're gonna do 3.5 down. Your loan amount will be 410, 125. Let's be a little more realistic. All right. Yeah, I don't want to do that. I want to do this. All right. So your mortgage payment is going to be, hold on. So your mortgage payment is going to be 3,343 a month. All right. Keep in mind DTI again. So if you're only making 6 grand a month, you're already well over 50% with just the house payment. We haven't included an auto loan, credit cards, any other debt that would be included on your debt to income. This is just the house. So you're making 6,000 a month. 3,300 is well above half of your check. So you're already in the risky side on DTI. You're already in the risky side on LTV. Your loan to value is 96.5% because you're only putting down 3.5, the minimum requirement. So you're risky in 2 out of the 4 areas already. You're risky in 2 out of the 4 areas already. All right, down payment would be roughly 15,000. Okay? Plus your closing costs, which we said was about 17,000. So you need $32,000. Your payment's going to be almost 3,400 a month. All right. Now let's say you even get a good rate. Let's say you get a 5.99. Let's calculate that. Let's calculate that. You're still at 3,000. So if you're making 6 grand a month, you're still at 50% DTI. You could possibly still do FHA. It's gonna be a tough one though. But we may be able to make FHA work. Where the problem's gonna be at, where's the reserves? So you're gonna need to have strong reserves. Using a gift and all that is good. So you're gonna have to have all hands on deck. You're gonna have to have all hands on deck because look at this payment. It's still $3,000. All right. And the rule of thumb is you want to be under 45%. You're still at 50 right here. This is 50%. All right. So keep that in mind. You want to make sure you're compensating for if you're weak, or as lenders would say, risky in one area, you want to be strong in the other three to balance that out. So if you're risky in the down payment, which is the LTV side, remember, a strong LTV is considered 80%. That's 20% or more equity in the home. So if you're at 3.5%, you're automatically considered risky. That's considered risky. All right. So you want to have strong debt to income. You want to have strong credit. You want to have strong assets. Again, you don't want to have any insufficient funds, no bounce checks, no large deposits. You want to make sure your assets are good in that area, and you also want to make sure that you have some reserves. Okay, because you're having a low down payment, you want that 3 to 6 months reserves so you can strengthen out the rest of that profile. All right, because a low LTV is a sign of risk to lenders. That's a sign of risk. All right. Now we saw what a 20% is. Let's say you wanted to put down, you don't have the full 20, but let's say you got 10% you want to put down. All right. All right, you're putting down 10%. So your down payment is going to be $42,500 for this home. 42,500. All right, with a 10%. We're going over LTV right now. Okay, that's a 90% loan to value because you put down 10%. So your LTV is 90%. Still considered risky. Better than 3.5, but still considered risky. All right, you're still gonna need about 17,000 to close. So that's $59,500. That's roughly 60K that you'll need in the bank. Again, you can leverage your 401k. You can leverage your 403b. You can leverage your thrift savings plan. But these would be considered a riskier loan to value ratio. Now, in order to get a Fannie Mae or Freddie Mac home, they do have programs. I believe with Freddie Mac, it's called the Home Possible, where you can put down a minimum of 3%. But your debt to income cannot be 50. Your debt to income needs to be around like 38%. Okay, conventional, if they're gonna, the conventional likes, like Fannie and Freddie like big down payments. They love big down payments because you're putting that ownership into the home. You're less risky because keep in mind, all the ownership you have in the home, that's your money. So you can leverage that when you need to. So they like that because they know you have access to assets. So the larger down payment you make, the stronger your profile will appear. The better chance you have at that approval. All right. But a strong loan to value is going to be 80% or less. 80% or less. You want to put down as much as you can if you want to be strong in loan to value. Now, if you want to put down a lower down payment, by all means, I've done a ton of them. I'm not against it. I'm not against it at all. I'm not against it, especially if you feel the value in those areas will be increasing. Yeah, I'm not against that at all. But keep in mind, you will be flagged as a riskier applicant as it pertains to your loan to value. But if your other compensating factors are strong, then you're good to go. You're good to go. You are able, you are allowed to put down 3.5%. If you're a military vet, you can put go zero down. And there are down payment assistance programs out there that will allow that. Okay, so keep that in mind. We'll probably touch on those at some point, but right now I just want to go over how to complete a mortgage loan application. Okay, that's what I want to discuss here. And I also want it to be hands on so you can realistically see what you're looking at here. But your loan to value is what's required when they talk about qualifications on property or real estate. They're looking at your loan to value, how much equity you'll be having in the home when it closes. And again, we've gone over it time and time again, but I'm going to repeat it. I'm going to always repeat it. Equity is your ownership stake in the home. It's how much you own. In percentage, that's your LTV, loan to value. In dollar amount is however much that dollar amount is. Okay. And a strong LTV is 80% or less. The closer you are to 100%, the closer you are to being underwater on your home. That's what underwater is when you're above 100%. When the amount of your mortgage is more than the value of your home. So you don't want to be in a position where that could happen. So putting down as much as you can is always going to help. That's why Fannie Mae and Freddie Mac do like to see you put more down on the home. That's why they like that. They like that. That's why they like that. Okay. So keep that in mind. Keep that in mind. All right. So as far as property, LTV is what's used as far as qualification goes, real estate owned, and that's LTV on other properties you may own. When it comes to property, when you're buying a primary home, this is the rule of thumb. Now, if you're buying a home that you want to rent out, you are required to do 20%. Because that is an investment home. That home's sole purpose is for investment opportunity. So you must put down 20%. So this 3.5% that I'm discussing, this zero down, that's for buying a primary home that you're going to live in, owner occupied. If you're buying an investment home, there is none of that jazz. Because now you're trying to be a businessman in realty. So you're going to need to put down the 20%. If you're buying a 2-unit home, you're going to need more. You're typically going to need about 10%, 2, 3 units, because most people who are buying a duplex or a triplex or quadplex, You can't live in three places at once. So you're probably renting those other options out. But you usually can get those at 10, 15%. But you're gonna want about 20% down when you're taking that route. All right, so keep that in mind. This is for single family primary residences that we're going over right now. Okay, with that 3.5%, 3%, less than 20% options. Now you can take a look here. This is called mortgagecalculator.org, and you can play around with this mortgage calculator. You can play around with it. Like I showed you here where we went on realtor.com, and you can look at homes that you like, and you can come over here so it can be a little more realistic. So it can be a little more realistic. Hold on. Yeah, let me make sure I had it right. So it'll be a little more realistic so you can see. All right. So you can see. Now, these are all estimates, they're not etched in stone. All right. But this is what you're looking at mortgage payment wise, almost 3,000 a month. So remember, income, property, assets, and credit. All right. Income, property, assets, and credit. The property, what they're looking at is how risky you are as it pertains to your loan to value. Again, loan to value is the loan amount divided by the value of the home. If you're buying a new home, the value is the purchase price. That's the value. It's the purchase price. That's the value of your home is the purchase price. Okay. All right. So in order to look at purchase price, it's whatever you're buying the home for. And however much you put down, that remaining amount is your loan amount. It's simple. These are simple things. These are simple things. These are simple things. All right. So to have a strong profile as it pertains to loan to value, you need to be 80% or lower. I can't say that enough because loan to value is something that's missed a lot. It's missed a lot when it comes to folks not understanding that it's based on how much you're putting down. And if you're doing a refinance, it's based on the value of your home. That'll be determined by an appraisal. Same with a home purchase. They're going to appraise it. The seller could say it's $1 million home. They're going to go appraise it and verify it's $1 million home. They're going to verify that. They're going to verify that. All right. They're looking at risk. Fannie Mae and Freddie Mac love to see 20% or more down payments, but you can put down 5% with Fannie Mae. You can go as little as 3% with Freddie Mac. You can. You can, which is lower than FHA to be honest, but your other compensating factors need to be strong. Keep that in mind. The other compensating factors need to be strong. All right. Now, credit. I mean, credit is going to be involved in all pieces because that's what we've been talking about. That's what a mortgage is. It's a credit transaction. Credit is when you get money lent to you because you don't have it or you don't want to use yours. You get money lent to you. That's called credit when you pay it back in monthly payments or installments, however you want to view it. That's credit. A mortgage is no different. It's a credit transaction. So, of course, your credit needs to be approvable. All right. Now, on FHA, you can have as low as a 500 credit score. Does every bank work with 500? No. No, they don't. But there are lenders and banks that do. I've worked for them. On your credit, as it pertains to your score, a strong credit score is going to be above a six. Well, I'll say a good credit score is above 680. A strong one is above 740. If you have an 800 or you have a 760, you're going to get the same options based on your credit. All right. That doesn't change. Just so folks are aware of that. 800 is great to have. Make no mistake. If you have a 760, you guys are getting the same loan programs, same rates and stuff. All right. So keep that in mind. Same pricing really is what it's about because the cost of interest rates are based on your credit scores. That's where credit is important. Okay. So if you're above a 680, your cost for interest rates will be lower than someone who's at a 620. Okay, there's breaking tiers in the interest rates based on your credit. That's where credit plays the role at. All right. With FHA, credit doesn't play as big a role, but it does still have the breaking and pricing where you'll get a lower closing costs as far as your cost of interest rate pertains to. It'll be a lower APR the better your credit score is. The lower your credit score is, that same 6% may cost you $1,000 more. Oh yeah. Oh yeah. Can you get the house? Yeah. But keep in mind, income, property, assets, and credit. So now we got to show a little bit more in the assets section because your credit's low. So it costs you more. So you need more funds to close. So now you might got to, hey, grandpa, I need $1,000 more on that gift. Or, hey, 401k, I need to take another 1,000 out. Or you need a commission or bonus from work. And I might have, let me throw this in here because I left that off on the income piece. On income, in order to be qualified and use your commission or bonuses or overtime, you must be in that line of work for 2 or more years. All right. Otherwise, you can't use your commission, overtime, or bonus income. You can only use your base salary, but you can use that if you've been in that line of work for 2 or more years. Okay. I know some will say if you work for that company, but it's the line of work. If you've been in that industry, being paid that same way. All right. So I do want to make sure I didn't leave that out because I've worked with a lot of folks who they're like, man, I work overtime. And it's like, man, you just started in this industry. We can't use the overtime just yet. You got to wait a couple years. All right. So keep that in mind when it comes to DTI. Okay. All righty. But back to credit. So it is important to have a high credit score because that can lower the cost of your interest rates because interest rates are like a commodity. It's like a t-shirt. It's not just a number, it's a product. Okay? And all interest rates have a dollar amount attached to them. All right? They all cost a certain amount. It's like you're buying a rate. Just like you buy a pair of sneakers. All right? So you got good credit, that rate costs less for you. Isn't that crazy? Interest is a fee you're going to pay the bank, and you got to pay a fee to get the fee to pay the bank. Don't you just love banking? Fees everywhere, fees all over the place. You got to pay a fee to pay a fee every month until you pay it off. Yeah. Yeah, that's how it works. Oh yeah, that's how it works. So the better your credit is, the less your cost of an interest rate will be. Okay. And ask the mortgage banker how much is your APR. Ask them how much does it cost. And if you're on the brink, let's say you got a 679. That's on the brink. A 680 will put you in a lower tier. Ask them what would it be if I had a 680. He can pull out his rate sheet, make him do some work. He can pull out his rate sheet and tell you. Make him do some work. And if he doesn't want to do it, remember I showed you all a hotline that you can call and report them because that is their job. That's their job. They don't want to do their job, you report them. Report them. Report them to the NMLS. Report them to the CFPB. There's a thing called Equal Credit Opportunity Act where they're not supposed to deny you things that you don't know. You don't have a rate sheet as a consumer. They have it. So they need to be on top of that because if you can improve your credit and it can benefit you, they shouldn't be worried about benefiting them. If it can benefit you and save you $1,800 and it's not something that's going to take you a couple years, why not do it? And they can tell you how much it would cost, you know. because it really is between 680 and 660. The pricing difference for interest rates can be expensive. All right, just be real with you. So ask them how much that interest rate would cost if your credit was a little higher. See, these are questions that folks don't ask about as it pertains to credit. They just want to know what credit will get them in the house, but they don't know that they're spending exorbitant amount of money to get those rates. Now, I'm a fan, or at one point, I was a fan of getting a higher rate because higher rates cost less. Getting that low rate is expensive to get the lower rate. And I'm just not a fan of paying the bank a whole lot of money to lower my fee that I'm going to keep paying them for the next 30 years or 20 years or however long your mortgage is. I'm just not a fan of that because interest is a fee that you pay the bank. And I'm not a fan of paying a large fee to buy a lower fee to pay the bank. To me, it's like, no, I want the fees as low as possible. Because I know if I have a high rate and I pay low cost or no cost, because I like to get a lender credit if possible, where they're paying me, the lender credit will reduce my closing cost. Okay. That'll reduce we're going to get into interest rates later on how we can reduce closing costs. All right. But a lender credit can reduce your closing costs, which in fact reduces your funds due at closing. And if I'm getting an FHA loan, I'll do a streamline and get a lower interest rate in a year. Same with VA, same with USDA. See, the government will allow you, if you get a government sponsored loan, they'll allow you to reduce that rate if rates go down in a year or 6 months with VA and FHA, or VA 6 months. You can go ahead and knock that out. Get your lower interest rate. You keep those funds in pocket there. And my thing with those lower rates is I make the same payments that I was making before, build that equity, accelerate that equity in the home. We'll talk about that later. All right. Right now, we're talking about how to complete a mortgage application and how lenders approve mortgages based on your income, property, assets, and credit, or income, assets, credit, and property. Okay. All right. So, as it pertains to credit, you don't want to have any liens, judgments against you. That can be challenging with qualifications, bankruptcies. All right. FHA is very fair with bankruptcy. If you file Chapter 13, 12 months after it's been discharged, you can apply for another mortgage. All right. If you file for Chapter 7, you have to wait 2 years. Okay. You have to wait 2 years. So, again, when it comes to credit, you don't want to have any outstanding judgments. You don't want to have any tax liens. You don't want to have any public records against you. You don't want to have any collections. If collections or late payments within the last 12 months can make things challenging. It can make things very challenging. That's why it's imperative, if you are building or repairing your credit, to get those credit deletions, especially if you paid it. Get those credit deletions so it's removed off your credit, not just showing paid, because it'll show you had a collection. The reason they put it on your credit was to get you to pay. Well, if you paid, they need to take it off. Request the deletion. They got their money. Request the deletion. Even if you paid, settled less than owed, still request a deletion, because they agreed to accept those funds. They got their money. Both party got what they wanted. So request a deletion. Them having that on your credit does nothing for you. They got their money already. So request those deletions so it's not showing on your credit report you just had a collection or you just had a late payment. Stay away from having, if you're going to apply for a mortgage, late payments within the last 12 months can get in the way, especially on FHA loans, government loans. Government loans don't like late payments. And by late payments, I mean 30 or more days, because that's what's reported to the credit bureaus. Government loans don't like it. Conventional, you might be able to get away with it more. Government loans aren't really a fan of you having multiple 30-day late payments. inside of a year and you're trying to get a house because your credit is showing as risky. It's showing as risky credit. It's showing as risky. So you want to make sure your late payments are in order. And in the mortgage world, late payments are 30 or more days. You don't have any 60 plus days. None of that activity. But you don't want to, and no mortgage lates. If you got more than 30 plus mortgage lates, it's going to be tough. Pretty much impossible on FHA, VA. But yeah, you don't want mortgage lates. You don't want late payments, especially on government loans as it pertains to having a strong credit profile. All right. Public records, any judgments against you, um, any liens. Now, what I can say, if you do have tax liens or any court orders that you had to pay and it's on your credit report, if you are doing a refinance, you can do a cash out refinance to pay that off and get it off your credit report. Of course, your credit would still need to qualify, and your income, property, and assets need to qualify as well. But if everything is in order and you have a tax lien, you are going to have. I mean, it's required. You're going to have to do a cash out refinance to pay that off, unless you're just going to pay it off out of pocket. That's a requirement. All right. So keep that in mind when it comes to credit. All right. So I wanted to pull up a loan application just so you all can see it. I'm not going to break it down line by line, but just so you can see what the mortgage bankers are inputting and what they're typing in and what's being used. Okay. And this is what they're looking at. All right. So let's take a look at what they're looking at. All right. Let me X this out. Let me X that out. Let me X this out. I got a slight OCD problem. So if I see too many screens up, I just start clicking them all off. All right. So uniform residential loan application, otherwise known as a 1003. This is the mortgage document. This is what it looks like. This isn't someone's, it's blank. But this is what it looks like. This is what they're filling out. This is why they're asking you these questions. So I know some folks are like, I'm not giving you this. I'm not giving you that. Well, if you want to take an application, these are what you have to fill out. All right. The mortgage loan officer is inputting it into this. It may be an online database that will generate this, but they're putting the information in for this. Okay. So as far as personal information, your name, date of birth, social. Are you a citizen or not? Are you going to be jointly applying or single application? Okay. And you're just going to go down your regular stuff. You always have to provide at least a 2-year address history. All right. All right. Employment. See, we're going right into income. And you see it's number one, income. All right. So if you're self-employed or pay stub W-2, you'll be filling out your gross monthly income. You see, that's where it comes from. Gross monthly income. All right. You'll need to provide the name of your employer. They do need the address. I know some people are like, well, what do you need that? You need to give them your position, what the title of your position. You need to give them your start date. And you see, how long have you been in this line of work? Because if it's 2 or more years, they can start using your overtime, bonus, or commission. That's why these questions are here. You also need to let them know if you're employed by the family member, property seller, realtor, or anyone else, to make sure that you're not in there, doing some backdoor activities, cheating the system. But anyways, if you own a business, they'll want to know if you have more or less than 25% income, because if you have less than 25% income, you'll still be treated as a W-2 pay stub employee. And even if they're showing a small amount on line 31, you still can use your pay stub and W-2, and you won't be subject to just the straight up self-employed tax returns. You can use that still. Okay. So that's why these are questions that are asked. But again, it's all to generate what your gross monthly income will be. All right. That's what it's about. All right. So going into your employment, this is if you're having multiple borrowers on there, self-employed, what have you, but it's still same business. All right. And this is more or less to help you out with those who are um familiar with what it is, or looking to be familiar with what the loan officer is putting in. All right, if you're getting passive income, and that again will be your alimony, child support, disability, interest and dividends, royalties, um, VA disability, annuities, any payments like that. If you're receiving foster care, um, payments, installments, retirement funds, that would all go here. All right. For any of that income from other sources, or we call it passive income, it's not income from working. Keep in mind, if you're receiving alimony, child support, or any separate maintenance, you have to show that it's going to continue for more than 3 years in order for it to be qualified income. Okay. All right. But that's what they're inputting here. All right, just so you can get an idea of what it looks like. And as you see, this is coming from Freddie Mac and Fannie Mae. So this isn't something that I just typed up. This is official. This is on the Fannie Mae website. All right. Assets. All right, you see, we're going into assets and liabilities. This is what helps determine that DTI. It also shows if you have the funds to close. But you're going to go over what bank account type, retirement types, other accounts you have, and they list, the different types of accounts right here. All right. All right. Okay. Put the institution, the amount, and all of that. All that like that there. All righty. Now, if it's other assets, like say it's real estate owned, you know, or proceeds from real estate owned, property being sold, you also want to provide that here and what the cash value will be. If it's like I said, an equity, you want to put the market value. All right. Liabilities, these would typically generate automatically from your credit report. If they've ran a credit report, if they're real old school and they're just asking you line by line, they can do that too. And they will be listing them here. Okay. Other liabilities they'll be going over is alimony, child support, separate maintenance, any job related expenses, like say you have a loan against your 401k or something like that, or just other expenses, any like wage garnishments. Not loan against 401k, I'm sorry, wage garnishments. Let's say the IRS is garnishing your check. Yeah, you got to put that on here because that's going to be the liabilities and expenses are what's used to calculate your DTI. All right. Real estate, which is property. You see how they break it down just like I was going over? All right. So, property you own. If you are refinancing, list the property you're refinancing first. Same would go for a home purchase. All right. But property owned. And you fill out all the information. Well, they're filling out all the information as you're providing it to them. Okay. I just wanted you all to get a look at this so you can see the breakdown of what I'm telling you. Okay. Now, if applicable, complete information for additional property. This is if you have any other homes that you own. You know, like I said, these are additional assets. If you have other properties and their value has gone up, you want to put that in there. And put that in there. Okay. All right, so loan and property information. And this is about the subject property. So if you're buying the home or refinancing the home, this will be more about that property, the value of the home, the loan amount. If you're buying or buying or refinancing, the address, the purpose of it. All right. All right. So there's more information on there. Now, next is the declarations questions, which is very vital and important. Okay. If you're going to be owning it as your primary residence, they'll also be asking if there's any outstanding judgments against you. If you're in delinquent on any federal debt, IRS debt, tax liens, those types of things. Are you a party to a lawsuit in which you have any personal financial liability? Now, I would just ask, are you a party to a lawsuit? Um, because if the judge rules that you have to pay, you know, $5,000, that may have to be added to your debt to income. So that's why these questions are in here. All right. And you may also have to show bank statements of what you used to pay that off with. Okay. But these are questions that are vital in completing. They're called declarations questions. This section asks you specific questions about the property you're funding and your past financial history. So they're very important and vital questions. All loan officers must ask you this. If they told you that they completed your loan application and they haven't asked you this, remember we talked about that hotline. They must take a full, clean, complete application. And if they haven't asked you these questions, you have not completed a loan application. If they haven't asked you these questions, you have not completed a loan application. Keep that in mind. All right. Now, sometimes they haven't asked you these questions because they literally haven't done a loan application. And especially if you're being very difficult with them and you don't want to talk about much, you just want to know the rates, the rates, the rates, then why would they ask you all of this? And to be honest, if you want to know the rates, you can go on Bankrate. You can go on. There's a lot of websites out there that you can go on, Market Watch, and just see what the rates are. Don't harass a loan officer and waste their time asking them the rates, because, like we've gone over here, before we get the rate, what's your DTI like? What's your loan to value like? What's your credit history like? Because that's really more what mortgage banks and lenders are looking for is your credit history. They want you to have a good score too. But trust me, they're okay with you having a lower score and paying more for an interest rate. They're good with that. Oh yeah, they're good with that. All right, but what's your credit history? What's your LTV, your loan to value? What's your debt to income ratio? How much reserves do you have? Because all of that plays a role into what your interest rate will be. So you're asking them to guess when you do that, and you don't know it. That's why I'm out here bringing that awareness for this, because you need to know that. Okay. All right. Foreclosures. Again, that may be a portion I left off in the credit section, but any foreclosures, it also goes along with property. Any foreclosures within the last 7 years, not the last year, not the last two. You can have a bankruptcy, but if you had a foreclosure, oh yeah, in the last 7 years, you're more than likely going to get denied. Just going to keep it real. Because remember, you're doing a mortgage transaction. This is a real estate transaction. And if the bank had to buy back real estate from you, they're not usually all that gung ho about giving you a loan to buy more real estate. Okay? So yeah, foreclosure could have harsher penalties than bankruptcy, because there are people who file bankruptcy and still keep the house. They don't necessarily go into foreclosure. They'll just be making payments on all their debts outside of the home. Okay. And in a year, they can buy another house and they won't have foreclosure. They got a bankruptcy, but they won't have foreclosure and their debt's been cleaned away. All right. Okay. Now this is just your acknowledgments. If you're a military vet, you need to fill this out. Demographic information. All right. This is about your race, ethnicity, and gender, which we've been doing a lot of discussion on redlining. These are the demographics they use to, like when the Ameris Bank case and the Mortgage Firm Inc. case, they go over these demographics and they see who they're lending to. Now, sometimes I could be wrong. Banks may be using this to determine if they will or won't lend to you. I don't know. But I'm not always a fan of checking off my race and ethnicity. I mean, my name should kind of tell you my gender, but I'm not really the biggest fan of that. All right. Because I want to, if you really aren't about race and color, then why should I tell you? Just do the job. Just do the job. But this question is something that you can decline. Now, I will tell you, if you're doing a mortgage application in person, it is a requirement of the loan officer to guess. And that's why I have the perspective I have about answering these questions. By law, if you were doing a face to face application and you say, I don't wish to provide this information, the loan officer is required. See where they ask you down here? Face to face interview. And that includes if you were doing it through Zoom or Google Meets. They're asking because if it's face to face, you as a loan officer, I am required to guess what your race was. I'm required to guess it. And I was never really that comfortable doing that. I'll be very, very blunt about it. Because how many people out here really know? I've bumped into folks that don't know the difference between an Asian and a Mexican. Just being real. And they're out here guessing. All right, but as far as ethnicity, some may or may not know, but ethnicity is Hispanic or Latino. Okay. Hispanic and Latino is not a race. Just so you're aware. This is what the Census Bureau uses. This is from the government. Okay. But Hispanic and Latino is an ethnicity. It's not considered a race. All right. It's not considered a race. Just so we're clear. Because a lot of folks don't understand. That may be the conversation you have amongst friends and family. But when it comes to government documents, that's not a race. Their race is either going to be white or black. They're going to be a white or maybe Asian if they are Asian. But typically, and you'll see race, American Indian or Alaska Native. Asian, that's going to include Asian Indian, which those are folks from India. They're considered Asians. All right. Chinese, Filipino, Japanese, Korean, Vietnamese. Those are all considered Asian. Other Asians like Laos, Thai, Cambodian, and so on. All right. Those are all Asian. So folks from India are considered Asian. Okay. And I'm not saying this to disparage anyone. This is to bring awareness because there's a lot of folks that are not familiar with the different racial breakdowns, which is not necessarily a bad thing, but it can be if you're using it just to be mean and throw jokes. But this is just to help practice racism. Okay. So that's why I'm not a big fan of this because breaking all of this down is to help practice racism. Black or African American. All right. Native Hawaiian or other Pacific Islander. All right. White. And then I do not wish to provide. But notice under race, you don't see Mexican, Puerto Rican. You won't see that because that's not considered a race. All right. It's not considered a race because you can have black Puerto Ricans, you can have black Mexicans, you can have black Cubans like Sammy Sosa, like Yasiel Puig. Those are black Cubans. Okay? You can have white Mexicans like Oscar de la Hoya, the boxer. Those are white Mexicans. All right? Same with Puerto Ricans like the rapper Fat Joe. He would be a white Puerto Rican. All right? He's not considered black. He's not a black Hispanic. He's considered a white Hispanic. So if you're filling out his loan application, he would check Hispanic or Latino, and he would check the box that says white. Okay? That's how that goes. That's how it goes. The government still asks you to or asking you to fill this information out today. All right? All right? And you have to read this disclosure. If any mortgage banker does not read you the disclosure before he asks you this question, he is breaking the law. He has to tell you why. These are what they call government monitoring questions, all right? And you see in bold, the law provides that we may not discriminate on the basis of this information. They have that in bold, okay? Because of the treacherous history of redlining, which was discrimination based on this information below. So certain folks, which I may be one, which I am one of them, are not comfortable filling this out because there's a history of this being used against my people. But anyways, this is a requirement to complete the 1003, otherwise known as Uniform Residential Loan Application. The bottom, you will see your loan officer, the company's name. Like I said, the NMLS ID will be there, and you can look up their NMLS and see their work history, if they've ever had any regulatory actions against them, um, what states they are licensed in, if they've ever had their license revoked in a state or suspended in a state. Look up their NMLS ID, the organization, and the loan officer that you're working with. Always look it up. Take that time. This is a big asset, the biggest asset you'll probably own. It only behooves you to make sure you're looking up who you're working with. Look them up. It's public information. It's free. It's a couple clicks away. All right. But this is the loan application. It's called the 1003, otherwise known as a uniform residential loan application, or simply put, a mortgage application. All righty. But I feel like I have bored you all enough. Wore your heads off pretty good today, but this is very vital information. It's needed. But please share this with others. Please share this with others. Don't be a weed, sow a seed, man, and share this. Hit the like button. Subscribe. Subscribe on our Rumble channel. Subscribe, where I'll be clipping everything up and dropping the clips off for those who don't have the attention span for these long courses that are 2+ hours. But I do clip them up so you can view them, and I try to break them down in a classroom setting, educational way, so you can learn. But I do appreciate everybody taking their time out and hopping on. Greatly appreciate it. I'm going to go ahead and sign off, man. This is the Constructive House. And thank you all again. Please hit the like button on the way in or out, depending on when you got a hold of this. But again, thank you. Thank you all. I hope you found that this was constructive and useful information to help with your mortgage literacy journey.